Mr Speaker, Labor will be supporting the first reading of this bill. I want to thank the Minister for advising me prior to this evening of the shortened report back period. Unfortunately, didn't mention the extension of ours business, but we'll see what we need in terms of the Select Committee, in terms of meeting the report back date that's being set. And I am actually quite comfortable with the underlying reason behind asking for this report back period, and that is the stated commitment to implementing the underlying policy framework as introduced by the former government and as agreed in a relatively non-partisan way across the House. And I just want to also say to the Minister that I feel very strongly that principle of collaboration is very important in this area. There are other areas where I think it's important as well, but I think in the area where we do need certainty, and this is about confidence in our capital markets, it's vital that we can work as closely together on getting a good outcome. I think the objectives, certainly on both sides of the House, are the same. I want to pick up on one of the last phrases that the Minister used in his comments, and that was this question of proportionality in response to the risk that's faced. And I've always been very determined in my approach to regulation in this area to look at that question of proportionality. And there are several layers of proportionality that I think we need to take into account. One is this, that there is a risk that when something bad has happened, that there is a tendency to over-compensate for that situation and over-regulate, thereby creating a disproportionate response to what is the actual level of the risk. And therefore, I think it is important to assess what that risk actually is right from the outset. And a good regulatory impact approach to regulation is one that will always define the mischief that one is intending to remedy, and then look at the variety of options that are available to remedy that fault, and then to look at what indeed the costs and opportunities, the risks and the benefits might actually be in any particular case. And I think that one of the concerns that I have heard expressed is that in passing quite complex legislation in quite a tight period in the lead up to a general election, it isn't probably ideal in terms of getting the detail absolutely right. And so I'm very comfortable with the idea that we will be looking at the detail rather than some of the fundamental policy drivers that certainly lay behind the framework that we introduced. The qualifying financial entity framework was actually designed with that concept of proportionality in mind, because it wasn't the same as an individual financial advisor essentially accountable to no one other than by voluntary membership of an organisation that ultimately ended up showing that it had no teeth if the individual withdrew from that organisation prior to the complaint being lodged by their disgruntled client. And so, but for the banks and other institutions that were going to be very tightly monitored and ensured, I think it enabled the government to look at a different framework for those large organisations that could take on the responsibility for ensuring that the right people were providing the right advice in an appropriate manner, and that there were consequences falling back on the whole of the institution if indeed those standards were not met. Now, I have to say that we introduced this legislation with the qualifying financial entity framework in it prior to the disclosure of the appalling example of ING and ANZ. And I have to say that that particular case made me think very carefully about the detail of the legislation that we had passed. Because if anyone had asked me at the time that we were introducing the legislation, if I thought that a bank, a registered bank in New Zealand, would be responsible for allowing individual advisors working within that bank to provide recommendations, not just advice, but recommendations to ordinary Kiwis that they should move their money out of their bank account and into this new diversified yield fund, or the income, I can't remember the name of the other one, the regular income fund. Thank you. I know John Boscawen knows the names off by heart. They're sort of etched in his forehead, I think. But but I think the expression, the point that I'm making is that if anyone had asked me if a bank advisor would actually make this recommendation to shift from one to the other without having the knowledge and the experience, and also without having the backup of the independent analysis for those products, I would have said to you it couldn't happen in New Zealand. I really would have said that. And I mean, and that was coming off the back of finance company failure after finance company failure. I would have stood by the banks and said there is no way that a New Zealand registered bank would have allowed that to happen. And it happened. And the consequences of that have been far-reaching, because they certainly have undermined confidence in what would otherwise be a very, very strong sector, and has proven to be a very strong sector in New Zealand and Australia, say, compared to the international experience over the credit crunch and the complete loss of confidence in the banking system internationally. So I have to say that this has made me re-look at some of this stuff around qualifying financial entities. And I heard the Minister say that the Securities Commission's already provided some advice that it will be looking for regulatory neutrality in terms of how it will be approaching the question of advisors, whether they're working for qualified financial enterprises or not, entities rather. And I think that, that possibly is giving me a positive steer that the Securities Commission is not going to allow a bank to get away with the sort of thing that we saw that bank get away with on that particular occasion. I'm sure that there will be more opportunities to debate that particular matter. I've drafted a private members bill which I'll be introducing into the House, hopefully when it's drawn from the ballot, and that is essentially designed with, yes, I have good luck with ballots, don't I? So maybe I'll be in for some good luck here too. But the bill is designed to remove from the law, or actually to add a provision within the Illegal Contracts Act to prevent people being put into a position where they essentially kneecap the role of the regulator in determining whether there's been a breach of the regulatory framework, which was the case for those that signed the settlement offer from ING. So I'm very hopeful that that will get drawn from the ballot, and there will be another opportunity to debate what has happened there, and hopefully to provide some comfort in the future to those investing in any sort of financial product, that the Commerce Commission, the Securities Commission, and the disputes resolution services that will be established under this legislation, or the prior legislation, that they will not be able to have their jurisdiction essentially ousted or limited in any way. I agree with the Minister around financial advisors that they must be competent and ethical individuals. I think there is still an issue around the distinction around the client base, and whether the client base is more sophisticated in one level, and I think there is a difference, and so we'd like to work on that. And I noted the recommendations of the Capital Markets Development Task Force in this space, which I think are very relevant to that particular issue. The final comment that I want to make is that I hope that the Minister will ensure that officials will be able to continue to dialogue with stakeholders over the period that the bill was before the Select Committee. I'm very comfortable for that to happen. I know as a Minister I liked it to happen, because it means that we've got up-to-the-minute advice as we consider very complex issues, and that would assist the process. So on that note, I certainly do commend the bill to the House.